There's some really interesting discussions and potential changes going on with ISAs right now, which I think, if implemented, could have some massive knock-on effects for us. To save you sitting through hours of debates and discussions, I'm going to break down the main talking points, and I'll be really interested to hear your thoughts on the proposed changes. The main discussion point is around pressure being put on Rachel Reeves by financial institutions to reduce the cash ISA limit from £20,000 down to £4,000. They claim that this would free up the £294 billion currently held in cash ISAs. They want to incentivize people to invest that money into the stock market rather than just hold that money as cash. And this is where the first bit of misinformation comes in, because the proposed change is on new money going into the account, not the amount of money that's currently held in the account. Although I should say that around £40 billion is deposited into cash ISAs every year, so there's still a substantial amount of money that this would affect. There's two main parts I want to unpack with this. The first is around the claim that this money would be put to better use investing in British businesses. This is the theory that if people invested more into the stock market, that could stimulate the UK economy. And in theory, that could be a good idea, but unless you specifically force people into UK-based investments, most will just have a global approach. They'll invest in global index funds. They may even invest in the S&P 500. If you invest into a global index fund, the majority of that money is going to US businesses. The UK makes up a very small percentage of most global indexes. So while some money will still flow into UK businesses via that approach, it'll be a very small percentage. I agree that something needs to be done because there's definitely been a lack of investment into UK businesses. The performance has been low, and that's had a knock-on effect of people wanting to invest in things like the FTSE 100. I think ideas like the British ISA is a good idea in principle. It just needs to be rolled out in the right way and not to be overly complex. I think we should incentivize rather than punish people to put money into UK businesses. I think giving people an extra £5,000 a year tax-free allowance to invest in British businesses is a good idea. I don't think there's many downsides to that. I just think one of the reasons that it didn't get implemented was actually such a small percentage of the UK population have a stocks and shares ISA, and then an even smaller percentage actually use the 20k annual allowance anyway. But by implementing it, it gives you data on how it might be used, and that can just be a starting point. And then once that's implemented, it can then be amended over time to make it a little bit more efficient. So much of this is about stimulating the economy and encouraging future investment later down the line. One of the main reasons that people don't want to invest into the UK right now is because of previous performance. You know, you can get a better return on your money investing into the US market or even a global approach than specifically investing into the UK market. But once we start to see a little bit of an uptake in performance, that could potentially encourage investors later down the line to invest in the UK. There's a lot of ifs in here, but I'm just saying potentially that could be the case. And the second part to this, and probably the most important part, is around education. In theory, it sounds like a good idea, encouraging people to get a better return on their money rather than investing in cash. They put it into the stock market. But the question is the education in place for people to do this successfully? More than likely, they would fall into pretty bad investment offerings from high street banks or other providers. You can just imagine it now, can't you, where all of these providers are suddenly fighting over an influx of money coming into their investments and the amount of introductory offers. People are going to be encouraged to put their money not in just boring index funds, having a global approach, because that doesn't sell as much and potentially they can't make as much fees on that. And that's where some of these slightly less optimal investment strategies come in, and that's potentially what people could fall into the trap of investing in. You can actually hold cash in a stocks and shares ISA, either through a platform that pays you interest on that money or through a money market fund. But again, this is something you're going to have to educate people on. There's also still a lot of fear around investing. People are scared to put their money into the stock market because it's money that they don't want to lose. And again, this is where the education comes in, because people have to be aware that this is a long-term thing. This is not putting your money into the stock market and expecting to get a return within a year, 2 years, even 3 years. This is 5 years plus. And I think this is where it's got to be really key and really clear about where this money is going, but also what this money should be for. People like the guaranteed nature of getting a fixed return on their money. They also know that £100 today is still going to be £100 in 5 years' time. There's no risk of that amount of money going down. It's going to be that £100 plus the interest that they've earned. When the stock market, obviously there's going to be volatility within that period. The downsides to holding cash as opposed to the stock market is inflation and the erosion of purchasing power, which is a little bit more of a hidden thing. And that's why people would prefer to get a guaranteed return on their money rather than taking the chance in the stock market. And the final part to this is just the general confusion that this creates. Already having multiple account types, there's different limits, whether it's for stocks and shares, cash, junior ISA, lifetime ISA, there's the innovative ISA. investing into pensions and SIPs. This is where we've got to be really careful that although we're trying to solve a problem, that we don't make it over complex and actually we get a negative effect from it. And this goes some way to explain why people are scared of investing, because it's deemed so complex, it's confusing them. People just don't want to understand. And because they don't understand it, they don't want to get involved with it. So although I agree with the principle of encouraging people to put more money into the stock market potentially could be a good idea, we've just got to be careful about how this is implemented and make sure it's still for the good of the people. Because the people putting pressure on the chancellor to make these changes is generally the financial institutions. Which, yes, there are some big positives of putting more money into the stock market, specifically UK businesses. But you've got to remember, why are they encouraging her to make this change? Is it for the good of the British people? Or is it because of the more fees that they could potentially earn from people investing their money? I'll be really interested to hear your thoughts on this. Is this a good idea? Are there other things that potentially could be implemented? Do you think this will actually come into effect? And how successful do you think it will be? I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I will catch you in the next one.